Hello and welcome to myfinancesteacher.org. This video is first released on the 9th of April to Gold members at myfinancesteacher.org, and this might become public for the viewers on YouTube several days later. If you want to get these updates in time, make sure you subscribe for Gold membership at myfinancesteacher.org. In this video, I'm going to talk about S&P 500. We're currently having a nice bounce in S&P 500. Since the recent low at the end of March, S&P 500 has already gained around 25%. And the reason for the bounce, even though the economic situation is still terrible, the unemployment rate is through the roof, is because I think at the end of March, S&P 500 was too oversold and it was time for some sort of a bounce. We saw positive RSI divergence on S&P 500 where the lower prices were not confirmed by RSI. Even in the midst of this terrible economic situation, with the whole economy basically being shut down, one would still expect this sort of a bounce as the markets are forward-looking, and with all the bad news unleashed onto the world, any sort of improvement, any glimmer of hope on, for example, declining number of cases or declining death rates for the virus would usually be taken very positively by the market. But that's only when the markets are extremely oversold, which we aren't at the moment anymore. However, during extreme oversold levels, markets do bounce, and a similar thing happened even in the midst of the financial crisis in 2008-2009. This is the end of 2008. That's where the bulk of the severe crash actually took place. Just after the most severe crash, we see that markets regained over 38%, with 38 being one of the common Fibonacci retracement numbers. Comparing to Bollinger Bands, we see that after poking a lot of times through the lower range of the Bollinger Bands, prices tried to reach for the top of the Bollinger Bands and nearly did it. What we see now in 2020 is somewhat of a similar situation. The bounce so far has even surpassed 38% retracement, and it's pretty close to 50% retracement. S&P 500 has nearly reached the top of the Bollinger Bands, so we might be coming close to the end of this bounce out of oversold conditions because, as I mentioned previously, the economy is still in the toilet. Going back to oversold conditions, over here on the 10th of October 2008, S&P was 36% below its 200-day moving average, and the bounce reduced that distance from the 200-day moving average down to about 21%. Recently, at the end of March, S&P was nearly 28% below 200-day moving average, and the bounce has already brought us only 9% below that 200-day moving average. So I want to repeat, caution is now advised, although personally I am still holding that S&P position in SPY that I've mentioned about before. The reason I'm holding it is because of some interesting technical details. I think there is a chance that S&P retests that recent low at the end of February, close to about 2850. And whether that happens or not, I personally am trying to keep my stop losses pretty tight. Looking at cycle duration, this bounce so far has only been going on for 16 days. It is still pretty early, even for a short-term cycle, which usually lasts for a couple of months. Although we might see a left-translated cycle which might top pretty soon, say at about 2850, before it rolls over sometime into late spring, early summer. Going back to 2008, that first short-term cycle after the most severe drop was also left translated, and actually it was a relatively short one lasting for only 42 days. So whether history repeats or rhymes, in either case, caution is advised in the form of tight stop losses, but we also want to take advantage of oversold conditions. Next, let's have a quick look at gold. I don't see much concern with gold at the moment. The ongoing short-term daily cycle has only been going on for about 20 days. That's ignoring that wick that took place on the 16th of March. And even counting the ongoing cycle from that long wick still gives us only 24 days within the ongoing daily cycle. After the first bounce out of these oversold conditions, I don't expect a decline into the short-term cycle low to be severe. And I don't think the chances are high that we have topped recently on the 4th of April at 1673. Over the next week or two, we might actually test the upper range of the Bollinger Bands before we head into the short-term low. An interesting pattern pointed out to me by one of the gold members at myfinancesteacher.org is this inverse head and shoulders, where the pattern starts somewhere at the end of February. And if we continue over the next week or so to reach the neckline at about 1690, that will give us the height of the head and shoulders formation of, say, about $200 roughly. And projecting $200 from that neckline, which would be a standard target for inverse head and shoulders, would give us a price nearly reaching 1900. How amazing would that be? I'm not really sure if that's going to happen during this intermediate cycle. I think it's more likely that during this cycle we top somewhere at about 1800s, that's a round number possible resistance at 1800, before we drop into the declining phase. Personally, I think there will be a chance to reach the all-time high just above 1900, possibly in the next intermediate cycle. That is why in some of my comments on YouTube I have previously mentioned that it will possibly take us a couple of years before we break those all-time highs. But however long it does take, I am confident we are going to see gold price above $2,000 in the next few years. After all, look at this chart of money supply. A relatively steady growth in 2019, and then all in 1 month of March, money supply increases by around 4%, and that's in 1 month. That's why I think it's important to allocate some of your capital to hard assets such as gold, silver, and Bitcoin. I know sometimes it's scary to do that with highly volatile assets, especially such as Bitcoin, but try to remind yourself sometimes of this huge spike in money supply. It is risky to invest into highly volatile assets, but it's also risky to keep your money in the bank. The value of that money is dropping all the time. So that's my view on the stock market and gold. Let me know what you think. I'm very curious of your opinion. I wish you a nice day and good luck in your trades.